Hello, happy Monday, post-Easter weekend. Markets were closed Friday for Good Friday. So we've got this dated as of April 17th, which is Thursday, and all the data is through then. But as usual, I'm Alex Varner, the head of research here at Main Management, alongside
James Maxwell, VP of Research here at Maine.
So yeah, let's get into the market note here. Kind of as standard, we've got the performance slides year to date. The broad indexes are a little bit more mixed, but the U.S. centric ones are negative. Europe and developed markets, Europe is a big part of developed markets, so that's led higher. Sectors more red than green or blue, I guess, since we use blue. But defensive leaning with staples, utilities, real estate, and healthcare kind of at the top. Staples and utilities are still the only two positive through the year. Tech and consumer discretion down the most. But we did have a pretty positive week. The S&P up, a bit eked out a positive week, but most of the sectors were in the green, and then most of the broad indexes were also in the green or blue for the week ended April 17th. Recession dashboard, no changes over the last week here. A lot of blue across the board. Kind of wait and see as these tariff, I guess timeline. I don't know what even you call it. Just kind of the vacillation, oscillation.
This cloud,
Yeah,
cloud above us.
yeah, the kind of overhang, sort of Damocles, if you want. Waiting to see how those go and how those play out in the data. So let's get into the data here. James, you want to take this one?
So retail sales was one data point that came out that was closely watched because of all of the discussions around consumer spending. It was actually broadly pretty strong, especially relative to kind of fears. You can see that the consensus was 1.3 and it came in 1.4, so just slightly above kind of stated consensus. But there's been a lot of fears over the past just few weeks because of things like the tariffs and impending kind of slowdown that people are talking about. But it was good to see that even amidst that uncertainty, amidst that slowdown, people were still out spending. A lot of that spending, or I should say, a portion of it was due to kind of a pull forward of imports and spending on things that would be affected by potential tariffs. So if we actually look at the sector breakdown, you can see that at the top there you have automobile and other motor vehicle dealers. So that's basically cars and car parts. And with the impending kind of car or vehicle related tariffs, people are naturally wanting to kind of get ahead of those.
Yep.
And not buy before the tariff 25% or whatever it actually ends up being. Same thing with building materials. You can see at the second from the top there, things like wood, lumber, steel, etc.
Kind of commodity based.
All those commodity based things where it's a lot of heavy importing from other countries. I think it's very natural, even if those things don't end up being tariffed very aggressively. It's natural to say, well, why risk waiting a month? I can buy now and lock in that price.
Yeah, and those two top categories there are also kind of generally tend to like autos are obviously a bigger purchase, like that's a large discretionary purchase, but it's also the sort of thing where people don't kind of do them on a whim. It's you think about buying a car for a month or two and you do some research and you look at it. And so I think this is, as James said, kind of a bit of a pull forward potentially ahead of those tariffs. So people have been thinking about it January, February, then they hear the tariff is maybe going on. They go, okay, I'm gonna do this now and not wait until April or May and risk a 30% or what have you tariff being put on this car that I'm buying. But it was good to see, sporting goods. A lot of that is kind of a little bit more domestic, and that had really kind of cratered post-COVID for a long time because a lot of people went out and bought bikes and tennis rackets and stuff for social distancing, and then those are kind of durable in nature. You buy a bike and it lasts you a couple of years, so those are really kind of cratered. But also seeing food services and drinking places and retail and food services, those are good because those are more discretionary. And seeing people continue to go out and spend, people can choose to eat at home, which is cheaper, or go out to a restaurant or a bar. And when they're choosing to do that, that's kind of a good indicator of confidence and, kind of seeing, all right, we have some discretionary income that we're willing to go out and spend.
Yeah. I think overall you can kind of see the broad strength in March. And you can see that also in other kind of real-time credit card spending,
Yeah,
etc.
and it's been interesting, as I think we mentioned on the previous slide, but the number beat expectations, and a lot of the data points that we've seen in the last month or so since the tariff
Mm-hmm.
conversation came into play is they're, quote, better than feared.
Yep.
And it's beating expectations. People are really kind of pessimistic and worried, and economists, when they look out and are forecasting, and then it beats and they go, oh, this was better than we'd feared, which
Yep.
is kind of an interesting phrasing that we haven't heard for quite a while,
Yeah.
just from like a semantic standpoint.
Yeah. Moving to the next slide here, we're looking at industrial production, which came out for March. And you can see that the blue bar there, which is industrial production, was actually below expectations at down 0.3% for the month over month. And then the green bar, which is manufacturing specifically, or manufacturing output, that was up 0.3. So manufacturing reached its highest level of output since October of 2022, which, if you look at other measures of manufacturing, is kind of interesting, because you look at things like PMIs, like ISM or S&P,
The regional surveys.
the regional surveys of the Fed, which, just for context, if you don't know, these are essentially asking different manufacturing and services companies what their plans to order are. Basically, more of a sentiment survey or expectation survey than an actual kind of hard data. This industrial production and manufacturing output are more of the hard data. So you continue to see this across different measures, kind of in the retail sales, which we just hit on as well, where the hard data is just fine, but the sentiment or the intentions or the planning to order, orders, types of things like that are all kind of weakening.
Yeah.
Sometimes those lead, sometimes they're not as clear. So it's kind of something we're watching, but it's good to see, at least in the actual like real hard data, that things are still solid.
And something we show on this slide, and this isn't unique to this data point, but you can see the dotted lines are these 6-month moving averages. And for both of these indicators, they've been, accelerating for the last 4 months here, which is a good sign. Of those 6 months averages, we show kind of trailing 14 months there, or 15 months, but they're at the highest level they've been in, in at least that time period, given what we see here. So seeing that kind of longer term trend is, it kind of puts in context, like, okay, the industrial production reading was down a bit. Okay, but generally it's trending higher. It's had 3 months in a row positive. So that's, that's a good thing to keep in mind a little bit longer term, just because, as we've said many a time, like one month or one data point doesn't necessarily make a trend.
Yeah. One underlying piece within industrial production is high-tech equipment, which we continue to watch as a measure of kind of these data center build-outs and AI, the AI story. You've seen all of these different kind of high-tech categories grow really, really rapidly over the past 18, 24 months, including, semiconductors, computers, etc. That's, I think, it plays into the narrative that a lot of the reason for these tariffs or some of the reason for these tariffs is a revitalization of these high-tech domestic manufacturing industries. Obviously, a lot of this growth is, looking back 12 months, even before even Trump was elected. But even during the Biden administration, you had, the CHIPS Act, you had a lot of this government almost, subsidies of these data center build-outs, in addition to massive money coming in from the Mag 7, from these big tech companies wanting to build out their,
you see their CapEx plans are up, 10, 20, 30% from where they were. And I think something, a key thing to look at on this chart in particular, that red dotted line is the moving average, is the simple average of these four kind of categories. And it's been positive on a year-over-year basis for 4 years now. So that means that, these have been growing very consistently at a solid rate. That thing's probably averaged 5 to 6% for the last 3-4 years. And if you look at the kind of, this is the year over year, so it's compared to prior year reading. But if you look at the indexes that these track, they've been up and to the right as far as they go. And that's, a good thing. There's not a single one of these that has been negative year over year for, 2+ years now. So that's a good sign that this is solid continuing growth.
Moving on here to housing starts. Housing has been a big topic of discussion, especially with rates rising in the past couple of weeks. that obviously hits on mortgage rates, and mortgage rates are kind of, the lifeblood of the housing industry, and
Mm-hmm.
especially in the past couple of years where they've been high and remained high, and every time they've kind of started to come down, it's that, okay, this is the time, and then
Yep.
every time they've gone kind of right back around that 7% level. You can see that this was a particularly weak month for housing starts, especially in the single family area. A lot of that might have been just a reversal from February, but also I think part of that also was also these, fears of, or not fears, the actual reality of higher mortgage rates, and then also the tariffs on the construction materials.
Mm-hmm.
It's a hard to build a house when you're not sure what the price of the lumber and the steel and all of the things
Yeah.
you're putting together actually are going to be.
Yeah. And a lot of these housing starts are dictated or put on the market by the big home builders.
Yep.
And so they're trying to forecast demand
Hmm.
and weigh that with input prices
Yep.
to say, okay, is it worth importing and starting to build these? Because there is a considerable lead time. I mean,
Yep.
it's months, if not a year or two, from when you break ground on a house to when you are able to sell it.
Yep.
And so there is a long lead time that they're having to play, and this high level of uncertainty has definitely not contributed. You can just see around that zero line. There's no trend. It's
Hmm.
right around zero, and it kind of depends on, okay, do we think we're getting a directionality in the
Hmm.
mortgage rate or not? And that 7% number is proven to be sticky, and I think that's also kind of an anchor in people's minds, around purchasing
Yep.
for the end buyer as well as the
It,
companies providing the supply.
it's kind of frozen here where everyone's like, okay, I'll wait for it to go down.
Yep.
And maybe it goes down, 6.5,
6.3, I think it got
6.3,
as low
yeah.
as, yeah.
But then kind of goes back up and everyone's like, okay, I'll wait again.
Yeah.
So, yeah. Moving to kind of the other big headline, or one of the last headlines this week was Chair Powell on Wednesday spoke at a conference and spoke a lot about kind of what his views on tariffs and the economy were as in context of the Fed. There is a lot of people out there saying, you know, if things get too bad with the economy, Powell will have this kind of Fed put, as they call it,
Mm-hmm.
where he'll step in, lower interest rates. Obviously, you've seen you've very likely seen the headlines of Trump pressuring Powell to lower rates because he wants that stimulation of the economy.
Mm-hmm.
Um, Powell kind of in his speech made it very clear that he and the Fed views tariffs as inflationary, especially for the short run, where like just on an absolute level, like prices will rise, and
Mm-hmm.
that is what inflation is. On a look forward basis, kind of past that 1 year spike up, that's less clear. A lot of that depends on if tariffs actually result in kind of more sticky inflation or structurally higher inflation. Our view that is that it's probably not going to lead to that. But he's watching things, and this is what he said. He's watching things like inflation expectations, both from consumers and what the market's saying. Here we compiled, I think it's 5 different inflation expectation measures, both kind of 1 year and then also 5 year. You can see those 1 years have been rocketing up, whereas the 5 years, for the most part, have been staying lower relative to the past couple of readings. So that's a good sign in our eyes where, yes, the 1 year inflation is likely going to be higher than we've had,
Mm-hmm.
have right now, but that a lot of that is one-off price increases rather than structural sticky
Yeah, you're not
inflation.
seeing this kind of expected to persist on the relative basis
Yep.
for the next 2, 3, 4, 5 years.
Yep.
So that's a good sign that they think it'll kind of wane or abate after
Yep.
you get through that one time kind of 1 year price increase. But also, this is again, we've talked about the hard data versus soft data.
Yep.
This is soft data, and a lot
Yep.
of this is consumers who tend to be maybe a little bit more kind of reactionary.
Yep.
They're people, they're everyday consumers. They're not people who work in
Yep.
financial services. They don't necessarily, pay attention to economic data and the markets on a daily basis. They're out there working their
Yep.
jobs and they see these headlines. And so this is, it's worth keeping in mind
Mm-hmm.
that a lot of the responses here are reactionary to headlines that they see and not necessarily, kind of looking through and digging through the data like
Mm-hmm.
we do.
Especially because it's inflation, even as a topic, has become so politically
Charged.
polarizing,
Yeah.
where it's the Biden inflation, it's the Trump inflation. It's like trying to pin it on whatever administration is in power. It becomes this thing where, and you've seen this in other measures where they ask people, what do you think inflation is going to be? This is in the University of Michigan survey. They ask people what they think inflation is going to be, and then they ask, okay, what political party are you? And Republicans, are considerably.
They're almost deflationary. It might be 0.1%.
During the Biden administration, they thought it was going to be consistently higher than the rest of the population, and then Democrats now think it's going to be consistently higher than the rest of the population, just based on who's in power. So
it's a clear, political bias in the responses there. But as it's still, this is something that does kind of weigh on the Fed a little bit in that it's not, it is an input for them. They look at data. This is data, soft or hard, aside, and it does raise the bar a bit for them to cut rates. If everybody is expecting inflation to be higher in a year and they cut rates, that's kind of the opposite of what historically they have done. But again, we have yet to see inflation really move higher. The recent CPI and PPI data points surprise to the downside.
They were very weak.
So that's a good thing.
All right. That wraps it up for this week. You can see the summary here. In terms of next week, what we're watching, you have durable goods on Thursday, both new and existing home sales, and then you have the University of Michigan consumer sentiment, which we were just talking about on Friday, and then you have the S&P PMIs on Wednesday. So that wraps it up. And we'll see you all again next week, and have a nice, enjoyable post-Easter week. All right.
Take care.